Indian markets have enjoyed an incredible run, making it easy to believe the rally would never end. Last week, Bank Nifty plummeted nearly 16%, a structural break that far exceeds the volatility of a standard market dip. Look at this daily chart of the Nifty index. For months, this horizontal channel acted as a reliable floor. Now, the price action has violently broken right through it. The selling pressure has been relentless, with daily candles closing lower and lower, completely ignoring what used to be strong support. Yet, if you look at the futures data right now, there's a strange contradiction. Tomorrow morning, we are heavily favored to see a massive gap up at the open. So what do you do when the long-term trend is collapsing, but the short-term momentum is pointing straight up? How do you trade a violent bounce inside a broken system without getting trapped? Without a clean reversal signal, going long here means you are attempting to catch a falling knife, prioritizing risky bottom fishing over established trend following. There is a popular narrative that the rising tide of the Indian middle class is enough to keep the National Stock Exchange propped up forever. Retail investors assume their combined capital can absorb the shocks. This bar chart shows monthly foreign institutional investor selling. In March alone, they dumped 1 lakh crore rupee on Indian equities, eclipsing the previous 5 months combined. Tracking back to July, the scale is staggering. Institutions pulled 3.5 lakh crores out of the market. Institutional selling on this scale completely overpowers the limited capital of the domestic retail investment pool. When institutions with this much capital decide to leave, they overwhelm any localized buying pressure. The market's recent climb occurred because institutions found it advantageous to keep prices afloat while they exited their positions, rendering domestic retail optimism mathematically irrelevant. This brings us to another heavily guarded belief: the idea that passive systematic investment plans, or SIPs, will automatically protect you from these market drawdowns through the magic of compounding. Simulating a standard monthly SIP into the Nifty from March 2023 to 2026 reveals a dismal 1.74% internal rate of return. Even with a more aggressive approach, increasing contributions by 1% every month, the return line converges at that exact same 1.74%. Buying and holding an index blindly is failing to outpace inflation, let alone build wealth. The structural decay of the market requires you to actively manage your risk instead of waiting out the storm. Despite all this heavy downward pressure locally, the S&P 500 is showing strong upward momentum today, which is directly pulling the Indian futures market higher. Add in some chaotic geopolitical headlines, like the US president floating rhetoric about regime changes, and you get a volatile, sentiment-driven gap up for tomorrow's open. This chart maps the likely path to reclaim the broken channel. It must first retest the previous floor at 22,800, which is now a significant hurdle. Clearing that floor opens the door to the midpoint at 23,200, with an absolute maximum stretch target of 23,800. Do not mistake these price targets for the start of a fresh multi-year rally. These are simply mechanical retests of previous support levels that have now turned into hard resistance. Knowing a bounce is coming, the immediate instinct for most retail traders is to jump in and buy naked long call options to catch the upside. Because the market has been falling violently, implied volatility is extremely high right now. That means those call options are incredibly expensive. Even if the Nifty moves exactly how you predicted, the heavy weight of time decay and dropping volatility will crush your position. To trade this specific setup safely, you need to structure a bull call spread instead. By simultaneously buying a call and selling another call at a higher strike price, you drastically lower the net premium you pay up front. This structure acts as a shield, making your trade largely immune to sudden drops in volatility and the slow bleed of time decay. In a market hollowed out by institutional exits, survival depends entirely on stripping out the emotion, respecting the hard price levels, and strictly capping your risk on every single trade.